Ever wonder who really controls the money in your wallet? Is it a group of people in some fancy boardroom? Or could it just be a piece of code, a global algorithm that literally no one owns? Okay, let's dive into this. We're going to break down the heavyweight champion, central banking, versus the disruptive up-and-coming challenger, cryptocurrency. So, to really get a handle on why we even have things like the Federal Reserve, we got to jump in a time machine. We need to go back to a time before there was any kind of safety net, when the financial world was, well, to put it lightly, a total mess. You see, before central banks, the economy was basically the Wild West. Bank panics weren't some rare event. They were a regular part of life. A single rumor could start, everyone would rush to the bank to pull out their cash, and just like that, the bank collapses. Your entire life savings could vanish in an afternoon. It was just this brutal, repeating cycle of boom and catastrophic bust. Now, this quote here from Paul Warburg, one of the guys who helped design the Fed, it just nails the psychology of what was happening. Without a central referee, it was every bank for itself. The very survival instinct that told you to get your money out first was the same thing that fueled the fire, making a total meltdown, what he calls pandemonium, pretty much inevitable. It was a domino effect. So yeah, it became pretty obvious this system just wasn't cutting it. And out of all that recurring chaos, an idea started to form. What if we created a central institution that was specifically designed to be a shock absorber for the whole economy? The real final straw was the Panic of 1907. It was so bad it nearly brought the entire country to its knees. That crisis is what directly pushed Congress to create a commission, and after years of studying and debating, the Federal Reserve Act was finally passed in 1913, and that's how we got the institution we know today. And that brings us right to this core idea, the central bank. The Federal Reserve is the central bank for the US, but most countries have one. The easiest way to think about it is like the head coach of the economy. Its job is to manage the team, call the plays, and try to keep everything running smoothly so you can win the game. So, what does this coach actually do? Well, this slide basically shows you its playbook. The Fed's main goals are keeping people employed and making sure prices don't spiral out of control. It's also the system's watchdog, always on the lookout for risks before they blow up. And when it works right, it can stop a crisis in its tracks. I mean, think back to 2008, or the big economic shock in 2020. The Fed jumped in with massive interventions to prevent a total collapse. It's literally built to be the antidote to that pandemonium we were just talking about. For about 100 years, this centralized model was pretty much the only game in town. But then, starting around 2009, this radically new idea showed up. It was powered by the internet and built on a completely opposite philosophy, decentralization. So what in the world is cryptocurrency? Well, yeah, it's digital money, but the really crucial part is how it's built. There's no headquarters, no CEO, no Federal Reserve. It all runs on a technology called a blockchain, which is basically just a giant public ledger that everyone can see. And this ledger is kept up by a global network of computers, which is what makes it decentralized. It's kind of like a huge, transparent chat group for money, where the rules are just code, and no single person gets to be the administrator. Okay, here's a fantastic analogy to make it super clear. Using crypto is a lot like using good old-fashioned cash. You hand someone a $5 bill, you get your coffee, the exchange is done. It's direct, peer-to-peer. But when you swipe a credit card, you're relying on a whole chain of middlemen. Your bank, the coffee shop's bank, Visa, you name it. Crypto was designed to be the digital version of that cash transaction. Direct, no bank needed in the middle. And this slide, this just perfectly shows you how disruptive this all is. Just look at this. The world's top financial regulators can't even agree on what to call the stuff. Is it a currency, like the dollar? A commodity, like gold? Is it property, like a house? The very fact that there's zero consensus here just shows that crypto doesn't fit into any of our old, neat boxes. It's something brand new. All right, so we've got the established institution and the radical new challenger. Let's put them head to head. Let's really dig into where they differ on the most important points. So on one side, you have the institution, the solid, government-backed central authority. It's got a century of history, it's got established rules. And on the other side, you have the network, this global, code-based system where no one is in charge, all built on mathematical transparency and open access for anybody. Okay, let's break this down, because the trade-offs here are absolutely huge. First up, authority. Central banks are top-down, crypto is flat. Then, how money gets made. Central banks can just create more money based on policy. It gives them flexibility, but it also risks inflation.
Most cryptos, they have a fixed, predictable supply that's baked right into the code. It's rigid, but it's totally transparent. And that leads to maybe the biggest difference of all, right there in that third row, stability tools.
When things go wrong in the traditional system, when a panic starts to boil over, there is a plan. There are actual people whose entire job is to stop the bleeding.
You can really think of central banks as financial firefighters. They can inject cash into the system, they can act as a lender of last resort to stop banks from failing, and they can change policy to calm everyone down. They have a whole toolkit designed for one thing: fighting financial fires and restoring stability.
Now, let's talk about a crypto crisis. In the crypto world, there are no firefighters. There's no central authority to call, no emergency funds to tap into, no lender of last resort. The code just keeps on running. When things go bad, it is every person for themselves. A high-tech digital version of the exact same pandemonium the Fed was created to prevent over 100 years ago. So, where does all this leave us? Well, we're standing at a massive crossroads with two fundamentally different visions for how our money should work. And honestly, the world is still trying to figure out which path to take.
And what's so fascinating about this is that there's zero global agreement. If you look at the sample of the world's economies, yeah, a majority allow it for now. But look at that. A huge chunk, more than a quarter, have banned it outright. This is a global debate with incredibly high stakes, and there's no clear winner in sight. And really, it all boils down to this one final provocative question. What do we want our money to be? Should it be governed by the flexible but also flawed and sometimes political decisions made by human beings? Or should it be governed by the transparent and predictable but also rigid and totally unforgiving logic of mathematical code? So would you rather trust a committee or an algorithm? That right there, that is the choice at the very heart of the future of money.